And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get back in the ride, with a little bit of...
Alasdair Macleod, a respected economist and head of research at Gold Money, has long maintained that both gold and silver are deeply undervalued in today's distorted financial system. In his recent analysis, he underscores that the accelerating breakdown of global fiat currencies, driven by unsustainable debt, persistent inflation, and central bank interventions, is paving the way for a monumental revaluation of precious metals. Macleod argues that gold and silver are not merely commodities but the ultimate forms of money, representing real purchasing power and financial integrity in a world where trust in paper assets is rapidly eroding. As global debt levels soar past record highs and interest rates fail to contain inflation, he believes that a monetary reset centered on tangible assets like gold and silver is inevitable. Macleod draws attention to how Western central banks have quietly lost control of the bond markets, forcing them into a corner where monetization of debt has become permanent policy. He explains that this process, the continuous creation of new money to fund deficits, inherently devalues currencies and accelerates the flight toward real assets. Gold, as the cornerstone of sound money, naturally benefits first from this shift. However, he emphasizes that silver, often referred to as the poor man's gold, typically lags before outperforming later in the cycle. This historical pattern, he notes, suggests that once gold breaks decisively into new highs, silver's reaction will be far more violent, reflecting both its monetary and industrial demand characteristics. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Well, basically the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years. And it's in supply deficit this year. And the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. We've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock, from pension funds, insurance companies, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like, payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to, finance your position for 3 days. That's all they're doing. This is just, storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. And there's very little available in the market. So all these talks about flying silver from New York back to London, I should think most of that silver is spoken for by the ETFs. I mean, when's it going to end, Alex? I just cannot see. This squeeze, I think, has got a long way to go, I must say. I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high, particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect preserved. So this silver thing is actually very, very serious.
According to Macleod, the silver market is in a far more precarious position than gold due to structural shortages and a dangerously over-leveraged paper market. He has repeatedly warned that the volume of synthetic silver traded through futures and unallocated accounts vastly exceeds the amount of physical metal actually available. This imbalance, he says, creates a time bomb in the financial system, one that could detonate when investors or industrial users demand physical delivery en masse. Macleod believes this eventual scramble for physical silver could expose the fragility of the current pricing mechanism, leading to a dramatic repricing event that redefines the true value of silver in relation to gold and fiat currencies. On the gold side, Macleod foresees a long-term shift away from Western financial dominance and toward Eastern monetary stability. He highlights that countries like China and Russia have been steadily accumulating gold as a hedge against the collapsing dollar system. In his view, the ongoing de-dollarization movement is not merely a geopolitical strategy but a financial evolution, one where gold reasserts itself as the foundation of global trade and settlement. As confidence in paper reserves like U.S. Treasuries fades, gold will once again serve as the trusted anchor of value. Macleod suggests that silver, by extension, will also benefit from this transition, especially as Eastern markets increasingly recognize its historical role as both currency and industrial asset.
It's obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically, to arbitrage into New York, a lot of that was leased gold because the principal storers of gold in the Bank of England are other central banks, and the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. So I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever. There was, I can't remember that there was a bullion bank way back in Eddie George's days, and I'm going back to, I think, sort of very early 2000s, when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England, because he was a wonderful trader and a really really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. And it's all over the press. Everybody knows about, that there's a shortage in the physical and the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market. But who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended, so it's unlikely that the US government will come to the rescue of London on this one. China, are they going to come to the rescue? I mean, in the past, they have suppressed the price. Of that, there is absolutely no doubt. But it seems to me they've withdrawn from the market. And not only have they withdrawn on silver, but you can see from their policy on rare earths that generally they're withdrawing from supplying needed metals and commodities from the West. So you can see that suddenly, where's it going to come from? And reports that I've had 2 reports in the last few days of enormous demand for silver and gold. I don't know, this is something you could probably comment on, but the dealers in bullion have been absolutely inundated with orders from private clients, from small people, and suddenly, they are just incredibly busy. I mean, I had I was meant to be doing a podcast earlier on this morning, but the people I was doing it with phoned me yesterday and said, "Look, do you mind awfully if we put it off because we're so busy, we just haven't got the time to do it." So this is new, and all this publicity is just driving extra demand. People are just getting in because they haven't got any. So they're trying to get into these bullion markets. So coming back to your question, I mean, there is no doubt that what's going on in the markets at the moment is specific to precious metals, driving up their values. But this is against a longer-term background of what's really happening, and that is it's the values of the paper currencies falling rather than the values of gold.
Macleod's analysis also focuses on investor psychology and the cyclical nature of precious metals markets. He notes that mainstream investors tend to chase momentum, often ignoring gold and silver until late in the bull cycle, at which point the metals experience their steepest price accelerations. This phase, according to him, will coincide with widespread realization that inflation is not transitory but structural. As real yields remain deeply negative, investors will rush to preserve their purchasing power, triggering a rush into physical metal holdings. Once gold breaches major resistance levels, he predicts that silver's volatility will amplify the move, potentially producing gains several multiples higher than gold's percentage increase. Drop your thoughts on Alasdair's analysis in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. Thanks for watching.